Our next guest says the AI trade remains on solid footing and hyperscalers are generating enough cash flow to invest in AI with one hand and return cash to shareholders with the other. Joining us now is Venu Krishna, head of U.S. equity strategy at Barclays. Venu, great to catch up with you. So I guess there's no real doubt that the Microsofts and Amazons and everybody else certainly have the free cash flow, the Metas, to do all this at this point. Does that speak to whether they're going to be getting a proper return on all the investment and whether investors will continue to reward them for it?
What I would say is that they are already monetizing it. So in their core businesses, which ranges from e-commerce to cloud services to a whole bunch of advertising and things like that, they're already deploying and monetizing it. For example, the software stack itself, where their core businesses reside, productivity improvement over there is about 30–40%, right? So, and that's the reason why I think if you look at big tech, which is obviously bigger than just the hyperscalers, but a small group, you saw their net margins actually improve almost 200 basis points, in the last quarter compared to now at this point in time.
To what degree is your call on the way the overall market is going to go and how earnings are going to track dependent on this one dynamic? It just feels like a very corporate capex heavy moment in the cycle as other parts of the economy maybe take a breather.
Yeah, that's a good point. That's something we've been pointing out for a while, that this is a highly bifurcated market. And what's working right now is the bigger, not just big tech, but tech in general and financials. Outside of that, to your point, a majority of sectors are facing various degrees of pressure on operating leverage and hence pressure on margins on the core businesses, as you saw in 2Q. But as far as tech is concerned, broadly the economy to a large extent, because it's been so important even in contributing to economic growth, is that for the foreseeable future, which means call it 12 to 18 months, it does look to us that the capital spending cycle remains intact. They're generating a lot of operating cash flow, like you said. They have a lot of flexibility because almost 50% is being used for buybacks. But down the line, I think eventually is when one has to think about the potential for what if things slow down. And that's what we did in our recent research.
And in one of the scenarios, I thought it was very interesting. You actually said, what if data center capex declines by 20% over the next 2 years? What would the impact be on EPS, on earnings for the S&P 500 and valuations? You came to the conclusion that it would be a bigger hit to earnings as opposed to valuations. Can you walk through what you found and what that differentiation would be? Because it did seem like the hit to earnings would be very small, but I would think from a market psychology standpoint, as you say, that would really hit valuations much harder.
Right. I think to understand this AI cycle, what's interesting is that the AI narrative or the theme has spread way beyond hyperscalers. In fact, our view is that hyperscalers are somewhat de-risked. Their valuation multiples have been coming down. In other words, they've been earning into their multiples. But the trade has spread to parts of energy, parts of industrials, utilities, and other parts of tech, the component supplied, like networking gear. So I think that is where we certainly see a risk. And to your point, when we did the bottoms up work with our analysts to look at the impacted areas, call it about roughly 80 stocks, the earnings impact is about 3 to 4%. But like you noted, what we felt is the risk is much higher on the valuation front, call it 10 to 13%, because that is where if you have a pullback in capex, it's not just the affected companies, but also the hyperscalers to some extent, which can see some moderation in multiples. So when you put those two things together, you're looking at roughly a 15% plus hit to returns for equities should there be a slowdown.